Well, hi. I wanted to talk about this week. This has actually been the beginning to a very interesting week in the market. I did make one change in the portfolio. I took out Charter and put in well, I didn't press L, which is L. The stock symbol is LYB. And I made that change because of the some of the fundamentals that I was looking at, and I just wanted to make that change for the better, hopefully for the better in the portfolio. Um, I wanted to, touch on something that's obviously the market's been running really hot, and especially on the technology or semiconductor side of technology. And some of the valuations have really gone to kind of like extreme values and very parabolic if you look at the actual charts on some of these moves. And it's hard for investors to see that and then not get into it or basically chase it. And you shouldn't. I mean, the common sense thing to do is to let them run a little bit and let them come down so that if you do want to get into them, give yourself a chance for them to come down because they will. Nothing can keep going up like they have, especially at the rate they have. So don't chase them. I mean, if you've already bought into them, then that's great. If you want to hold on and really ride this roller coaster ride, then it's up to you. If you want to take something off the table, you can also do that. So you've got some options if you're already in the stock. And again, you know the companies that I'm talking about. I mean, you have companies like Micron, SanDisk. You have also like Intel. I mean Marvell. You can go on. AMD. I mean, they've had a tremendous run, and all the companies have actually that are associated with that industry, especially when it comes to data centers. So just be careful. I think in general the market has has gotten maybe ahead of itself a little bit. I'm not saying that the current trend is going to end. I mean, in fact, if anything, it probably will go higher. Um, but just keep in mind that the volatility is going to be high and will probably remain high, actually. And that's what I'm seeing. I'm actually seeing that in everything that I'm currently looking at, not only at the S&P 500, obviously, but everything around the S&P 500. There is a lot of volatility, and the volatility, if anything, is going to maybe spike even more going forward. So just be careful. Um, but I do think this is I mean, as far as the technologies around AI and the movement in AI, I mean, we still have a long way to go. If you really dive deep into the technologies and what it's doing and what it's capable of doing and the things yet to come, actually, there is still a lot more that can be done. We're just really starting out right now. So I think that those investments in those companies that are actually, focused on those areas, you know, not that all of them are going to win, but I think many of them still have a lot to come. But I did want to talk about, and I'm just going to touch on this right now, and we'll do a session on this. But one of the things that you can do, to really understand how valuations are come about is, and this is a framework, that I use, and it's really meant for more of the established companies that actually have been around. They're actually generating income and cash. This is one of the frameworks that you can use to really measure what the valuation should be. If it's a small company or a startup company, of a company that's actually still losing money because they're basically in that growth phase where they just want to get customers. You can use it. It's a little harder, and the amount of expectations that you're going to build around as far as when they get to a net income or even cash flow positive. That comes back to the equity. I mean, that gets to be, again, it's not going to be very precise. It becomes more uh, a little bit of a science project, actually, in that case. Um, and you have to compare it to other technologies that have gone through the same phase or same set of phases. But for most companies, again, this will work, and it's really, to come up with a valuation in the company. It's actually made up of several things. Um, and by the way, FCFE stands for free cash flow for equity. Um, and so basically, this is the cash flows that are coming directly to the equity side of the investment. And the way you do it is you actually have to calculate through two present values. One is going to be the present value of the FCFE stream, which you will probably do it for, like, let's say 5 to maybe 7, maybe more years. And then you're going to come up with a terminal value for the remainder of the years that you expect the company to be around. And in most cases, you're going to make the expectation, you're going to use the expectation that the company will be around for essentially forever. You don't have to, but in most cases, you're going to say that company is going to be lasting for a very, very long time, which is almost forever. And you get the present value of that terminal value. Okay. And and to calculate the FCFE, you take net income, you add back into it depreciation and amortization, you subtract the CapEx, you subtract the change in working capital, and you add back to it the net borrowings that the company does. And that gets you to the FCFE. And you do that for each year that you want to basically run up to until you do calculate a terminal value. Um, and again, this framework is really designed to really put a value, um, on the actual company, on the equity of the company. It focuses on the cash, and again, cash that's coming back to the equity side. And some of the key things to this is that, and as we run through an example, you'll see that most of the value will come from the terminal side. I mean, most of it. And again, that's based on the continued growth of the company over the many years to come after you've actually done the individual years where you calculate the FCFE, um, as well as the required, return on equity. Those two factors actually drive a lot of this valuation. It's the return on equity that you expect, from the company, and also not only the growth rates during the years that you're actually calculating the individual FCFEs, but also then when you expect what you expect to grow, what the FCFE that you're going to be using for the terminal value, what you expect that to grow into the years that you're actually, again, calculating that terminal value. So so again, and that's most of it. So if you just change a few things here and there, the actual value of the company can vary by quite a bit. So it's not a very precise science. You do have to, again, uh, come up with some of these ingredients and do some sensitivity analysis as you're doing it, but keep in mind that there is no precise way. And that's what actually creates a lot of volatility sometimes in the market, because everybody who's maybe using the same model, this model, can have different values, especially different values when it comes to the growth rates, the expected return on the equity, and again, some of the calculations that they actually do. So again, we'll talk more, and we'll actually go through an example at the next session. Okay, and have a good week.